Hi there, and welcome to the Stockscores Market Minutes for November 22nd, 2013. This week, I want to talk about expected value, and this is a continuation of last week's discussion on reward for risk. Now, what would you think of a strategy that resulted in the following trade gains and losses? And these are my last 10 trades that I have done in my Trade Alerts newsletter, which is available at tradescores.com. So, the most recent trade that I closed out, meat, losing 15%, you can see the other gains and losses there. And I think most people will look at that and say, yeah, it looks okay, but not outstanding. We've got 60% winners with the average gain being 9%. And I would think it would be pretty reasonable for someone to think that that doesn't look all that wonderful. However, when we add in the reward for risk element, and now you can see these extra column of numbers. For meat, you see a minus 1.15 and OTIV a plus 3.35. Well, now it starts to look a lot better because the total reward for risk over these 10 trades is 13.83. Now let me explain what that means. If you were willing to risk $1,000 on each of these trades, your position sizes would have varied. The number of shares that you bought would have been a different amount for each one because each stock had a different amount of risk. For example, meat, the downside risk was a little under 15%. And so if it went up 30%, it would have made a reward for risk of 2. Well, overall, you can see that the overall reward for risk is quite positive. Even though the success rate was only 60%, the average return for risk of the winners was 3, and the average return for risk of the losers was minus 1.17. And so combined, over 10 trades with $1,000 of risk, this strategy, these picks, made $13,830. And if you only risked $100 on each stock, then it made $1,383. Whatever the reward for risk is, multiplied by the risk tolerance, is how much you made on these trades. So having a 60% chance of making an average of 3 times risk while losing minus 1 40% of the time is a winning strategy. Now, if you were in school to say to your parents coming home, hey, I got 60% on my exam today, they wouldn't be all that impressed. You got a C. But in the market, it's not about how often you are right. It is actually about how much you make when you are right versus how much you lose when you are wrong. I've just shown you a strategy that was only right 60% of the time, and yet it was a real good moneymaker. All right, let's get into the weekly analysis. This is the chart of the SPY, and we've talked about this many times in the last little while. We've got a bull market. We're running away from the trend line to the upside, and that means the market is getting risky, but there's really no sign of a problem here. We're not flirting with the downward trend line. We're not even showing signs that a correction is likely in the near term. And so we must remain bullish, although I would have to say cautiously so given the gains so far this year. The TSX is trying to play catch up. It broke out 5 or 6 weeks ago. And again, nice bullish trend in the TSX, a little bit above the upward trend line. That means there's risk of a correction in the near term, but that would just take it back to that upward trend line. Pretty normal course of action, and so you have to remain optimistic about the TSX, although with a little bit of caution that there may be a short-term pullback. Treasury bonds have gone into a sideways trading range over the last few months, and we're at the bottom of that range right now. So we should see a bounce back in treasuries in the near term, but there's really no sign that we're reversing the downward trend. It's more a factor of being more stable than we have been in months past because we're going into this sideways range. And I think that's what's going to happen for treasuries in the near term is we're going to meander sideways for a while. The market is looking towards an end to some of the stimulative action, but at the same time, there's really no signs that an end is coming. And of course, when you look at this chart, just remember, if this chart is going down, that means interest rates are going up. The fact that this chart has been going sideways for the past few months means that interest rates are relatively stable, but not as low as they were earlier in the year. All right, China market had a good break this week and is likely to move up towards the red line of resistance. I think this chart is not so much one of optimism about what's going on in China, but instead a simple stability that is coming into China. There's been a lot of concern that, China was falling apart and the world would have a lot of issues economically if China fell apart, but I just don't think that is the case. The China market is stable, doesn't show a lot of optimism yet, but it is stabilizing, and that is good for the global economy. Emerging markets, a similar situation. We've been stuck in this sideways trading range for 2 years now, and we are moving up towards the top of that range. That's a positive, but until we can break through that long-term resistance at the red line, I wouldn't get too optimistic about emerging markets. We're, again, stabilizing, looking better, but there is work to be done. US dollar is in a downward trend. Over the last 4 or 5 weeks, it's jumped up a little bit, but it is now stalling in that upward move, and I think we're probably going to stall here. Now, if we break this downward trend line, we're in a little bit of a flag pullback for the last 2 weeks. If we break through that red line, then I think the US dollar could recover. That's probably going to correspond to some weakness in treasuries, which would mean interest rates are going higher, those sorts of things. Until I see a break of that red line, I'm not going to worry about those things, but certainly something to keep an eye on. Gold, I had been neutral on gold for a number of weeks because it had formed a rising bottom. It was flirting with the downward trend line, but it failed to break the downward trend line. I've drawn that downward trend line in red, and therefore we must go back to a bearish stance. I don't see considerable downside in the near term because we are approaching support. I think we probably have another week or two of downside before it bounces. But unless we break that downward trend line, we cannot become bullish on gold. Oil has suffered in the last 2-3 months and is now approaching support. So some of the selling pressure we've seen in oil stocks in recent weeks should dissipate as oil should stabilize. What we're really seeing is the tension in the Middle East, which started early in the summer, caused that rally in oil. That tension has gone away. Oil is falling back into its trading range that you can see there from the middle of 2012 and through the middle of 2013. And I think that's really what we're doing, is we're just taking away the Mideast tension pricing factor and going back into the range that we were in before. Finally, fear. There is no fear in the market, and that is somewhat worrisome. The complacency that we see through the VIX, the fact that we're trading at the lows and that we are in a downward trend, is a bit of a concern because investors really aren't afraid of something bad happening, and sometimes that makes the bad happen even more sharply. All right, so I'm bullish on stocks, US and Canadian, but with an ounce of caution because stocks are strong but risky as they have run up and away from the upward trend line. Now, gold has failed to break its upward trend line, and so we must go back to being bearish on gold, while oil has fallen into a strong area of support where it should stabilize. And of course, the market is showing very little fear, and this complacency could lead to trouble. No sign of trouble yet, but I would not turn my back on the market these days. Well, that has been the Stockscores Market Minutes for November 22nd, 2013. Have a great week in the market and trade well.